there you have it. Back to the markets this morning. We're looking at another sell-off on this Wednesday morning. U.S. futures, Dow futures up 251 points. Lots driving this action this morning. We want to bring in Sethi Financial Chief Investment Officer Rob Morgan is here. Good morning, Rob. And Vining Sparks Chief Economist Craig Dismuke is here. Good morning to both of you.
Morning.
Craig, first off, what's driving the sell-off this morning?
Well, I think obviously what's happening with China globally, there are a lot of concerns out there. The Chinese government came out overnight, so they were going to potentially extend the ban on selling. They have devalued the yuan. And you get this general fear about the economic growth rate in China. And you look at the manufacturing data, you look at the services data, and they're both in negative territory now. That obviously is creating some fear. And it's rippling through the Asian markets, the European markets, and then kind of as an afterthought, the U.S. markets. And so I think the U.S. markets are responding largely to that.
Interesting, Craig, that you didn't even mention the North Korea bomb test. Rob, is that leading to maybe an exacerbated sell-off this morning?
Well, sure. Obviously, the bomb test is exacerbating things. But if you just look at that in isolation, is that going to impact U.S. earnings? No, it's not. So, but as Greg said, I mean, there's plenty of other stuff to be concerned about here, not only with the China situation with their economy, but on Monday, the ISM index was in recession territory at 48. So I still think this is going to be a pretty good year for stocks, but there are definitely some storm clouds gathering out there.
All right. Anthony, anything we should be looking at that we're not?
I mean, the thing I guess I would like to ask you guys about is the yuan is at a 5-year low. The dollar is appreciating. And so what do you think that means for the U.S. and the global economy in 2016?
Yeah, so I think that's the big challenge right now is when you look at the global landscape and you look at the Fed, and to me, everything this year in the U.S. markets is about the Fed. How many times will they raise rates? They've said they're going to raise rates 4 times based on their SEP projections. I don't think they can get in 4 rate increases. But you look at what's happening with China and with them devaluing the yuan, and with weakness in China comes lower commodity prices. It's not going to affect U.S. economic growth so much. Only 7% of our exports go to China versus 19 that go to Canada versus 14 that go to Mexico, and I think it's 11 that go to the Eurozone. Those are bigger trade partners for us. The bigger issue is that it creates financial market volatility, and it's creating lower prices, lower commodity prices, and lower input costs, which I think drives inflation lower, and it makes it harder for the Fed to raise rates.
All right, so when we look at those commodity prices, they are shaping up to be another big story of 2016. We're 3 days in. But, Michael, when you look at oil prices, more than a decade low in that WTI contract. Brent crude trading at about the same price, down by just as much. Jim Rogers, notable commodity investor, was on at the top of the show yesterday, said he thinks oil's bottoming out here. Do you think there's more selling to go?
You know, I think all of this, and I think that Craig brings up great points in terms of stuff is going to be in deflation in 2016, whether it's commodities, whether it is low-end manufacturing coming out of China. The devaluation on the yuan is just another source of downward pressure on the price of stuff. The great thing, though, in terms of U.S. growth and European growth is we don't make a lot of stuff. We're more a service-driven economy, and if you look at the price increases that are happening in services, 3% year-over-year price gains in services and accelerating pretty rapidly. So I think that's probably more of what the Fed is looking at. They recognize that stuff is in deflation, but that services are more important to our economy.
Yeah, and I agree with that. And I think the thing that concerns me the most is the volume or the size of the drop. And commodity prices are down 30% year over year. Oil prices are down 47% year over year. The dollar's up 25% from the range that it traded through this expansion/recovery. So to me, those big input they're so sizable that it creates a concern.
All right, Rob. So leave us off with an actionable idea. What do you do in this sort of environment?
Well, I cut back my weighting on stocks and shifted towards more defensive sectors, and I really like financials here. In a rising rate, rising dollar environment, I think we're finally going to see some health put back into financial balance sheets. So That's probably my top idea right now.
Anthony, you like that idea?
Yeah, I do. I think financial stocks are probably the best play for right now, given what's going on. Just to explain quickly, as the yield curve starts to steepen, it makes it easier for these guys to increase their profit margins because they're borrowing short-term, lending long-term, and they're making up that spread.
What if it inverts, if more and more investors, particularly in fixed income, think that there's a recession that's nigh? So you have higher short-term, lower long-term.
That is a possibility, but given where rates are right now, Dagan, I think it's very unlikely because of the low starting point on the front end. I think makes that unlikely right now. And if you look at all the governmental borrowing and the demand for treasuries, my guess is that you'll be, I would say 150 to 250 basis point spread, which is plenty of room for these financial companies to start printing money.
All right, great stuff, guys. On another big morning, another big sell-off as we kick off 2016. Thanks to Craig Dismuke and Rob Morgan for chiming in on that.